All right, sorry about the um, interruption between video one and two. I was just gonna make one video, but um, had some stuff I needed to take care of working from home here, so never know if the kids might choose to interrupt. But anyway, I'll dive right back into to where we were. We were talking a little bit more about just the profile of bond investors, and I think we're seeing some changes this last year. We've had COVID-19, and again, another change to the landscape of investing, where people are a little less willing to actually invest in bonds, which is interesting because you would probably say that people would be less willing to take on big risks because of the fact that we have hate to use the word, but more uncertainty and more challenges. And typically, you would see that as a headwind to investing. And so you might as well just invest in bonds and be done with it. However, because of such an active role that our Fed has been taking in lowering interest rates in an attempt to kind of stimulate the economy, bring people into, taking on more debt, and corporations, to try to grow during times when we would normally be contracting. We see bonds get such low interest rates anymore that a lot of people are saying that it's just not going to be a part of their investing portfolio. Now, a lot of people still will at least make them part of what they do in investing, but that's becoming less and less, I think, the case as we see interest rates dip below 2%, 1%. People started to think, hey, maybe I can go find, more available other options, or just accept the risk and invest instead in stocks. Traditionally, older adults, retirement plans, people who want the steady fixed income, who are concerned about preserving that principal that they invested in, would choose bonds over stocks. So how does a bond begin? Well, I take this little guy here, right? A bond being a piece of paper, and if we call him bond, it has to be conceived from ultimately the entity that needs a cash infusion. And so let's say it's a corporation, and we call that mom, needs a large sum of cash to fund a venture, but doesn't have it available to them. And so they decide to go ahead and issue a bond. They go to an investment banker, does the underwriting, establishes the interest rate of the bond, and then registers that bond with the SEC, promote the bond to investors who choose to invest in it. And, a lot of times we think individuals, but the truth is those bonds are not typically associated to individuals, especially whenever they're conceived like that. They're going to be sold to large pension funds and, big investors that will buy up, millions of dollars worth of these investments at a time. Each year, a bond will pay out cash and interest to the bondholders. I mean, it's very similar to the things that you would take out a loan on, right? Like a mortgage or something like that. Ultimately, reaching maturity, though, all of the original invested money is returned to the bondholder. So, bond prices, and ultimately, this is another story of risk and its association to investing. Even though bonds are meant to be a safer type of investment, we still find risk permeates these types of investments. So risk number one is that this entity would not pay your investor back the principal or the interest in which they are expecting. And then also we see people who buy and sell bonds just like they buy and sell stocks. And if that's the case, we do see the market price of bonds go down and up. Now, bonds will typically go down if we see interest rates rising, because what happens is we say, hey, listen, a bond really is a bond, especially if it's issued from the same place. And so if you have one bond paying 3% interest and now the market says that the new issues are going to be at 4%. What's the difference between the 3 and 4% yield, right? Other than the fact that one was issued maybe earlier in time and one is issued now. Nothing different, right? And so the 3% bond will be discounted in value until it gets to a point where it will be earning 4% return. Okay, now if you hold it to throughout the entire life of that investment, you know, it's not gonna make a difference really. But if you're buying and selling in bonds, it will. And then the other risk factor, of course, always is inflation. And so the interest earned with a bond will not sufficiently counter the increase in inflation over a time period. And going back to risk two, what again that example is like we don't live in a bubble. Like our world is constantly changing and interest rates are changing. And you know, as we you know, just this last year, you know, it's a wild example, but sometimes they're a little more subtle. But this year we saw, you know, a big challenge to our world, and so the Fed acts, they lower interest rates, and so that had a ripple effect on all the bond markets from there on. So you know, there are special cases. You know, we always want to say, hey, listen, the Fed has this wonderful ability to be able to print money, and so because of that, the idea of default is much lower, right? We would have to have a cataclysmic event here in the United States for our U.S. Treasury not to be able to cover our debt obligations. And we saw a little bit of that in the wake of the Great Recession. Greece, Portugal, Italy, some countries in South America, their bonds became, you know, challenged in a lot of ways. And so because of that, they went to junk status and kind of, you know, had to bounce back a little bit because they were in fear of being defaulted. All right, let's keep moving on. Bond ratings. So like I said, S&P, Moody's, we have a few others, Mergence, Dun Bradstreet, and Fitch, that all rate bonds according to their value. Now, sometimes there's a little bit of what do you call it? A lack of to operate outside of self-interest in these bond ratings. If you've ever seen the movie The Big Short or read the book The Big Short by Michael Lewis, maybe the book would be a little bit better. Well, both of them have a little bit of, you know, a lot of expletives, which isn't uncommon to the, you know, big dog financial industry. But nonetheless, they're very interesting cases of kind of the Great Recession and things that went wrong. Well, one thing that did go wrong were bond ratings agencies that were issuing out AAA rating for basically packages of subprime mortgages that were awful and just complete garbage. Should have probably been even at junk rating. And so that caused issue and ripple through the whole system. And so that's an example of that you see here in these bond ratings. So anyway, that homework is usually for students that I have. So please disregard that. That's for an NC class. Bond prices and yields. All right. Let's talk a little bit about this. A little quote from Benjamin Franklin, right? Beware if you take out loans. That's kind of what it says, right? Which, you know, bonds are associated with, because we live in a debt-ridden society. Let me just put it that way. And so because of that, that's where this bond system has grown and developed out of. Bonds, like stocks, are bought and sold, typically denominated in $1,000 chunks called par. Par value is 1,000, but that par value can change because we live in a dynamic world and interest rates are constantly moving up and down, thus retroactively affecting those bond issues. And so we know that the bond that's issued can only, you know, it's issued in $1,000 increments and it's a set fixed income, right? And so because of that, though, bond prices going up and down will change that par value of 1,000, all right, and make it move up if interest rates are being lowered in the future, or they'll make it actually be less than $1,000 if interest rates are on the rise, all right? So anyway, you typically buy a bond set at 100, like a percentage 97.5 would cost you $975 for a $1,000 bond, and so forth, so on. The relationship between interest rates and bonds looks like this. When interest rates go higher, bonds already exist get discounted to reflect the fact that they offer lower than prevailing rates. Interest rates go lower, bonds that already exist go higher. The text, that's actually probably not, they're the same textbook, so just ignore that page number. Using a financial calculator to determine prices looks like this. A bond maturing in 3 years. So this is pretty simple equation. We're going to solve for present value to basically change to figure out where it's valued at. And so you can factor it in with a calculator like that. Bond prices and changes in market rates are inversely related, is ultimately what we're getting at. And so your current yield, okay, is the annual interest payment, okay, and they're going to be paying that out. Now the yield to maturity considers interest in that change in the bond value to figure that out. And again, you can use your financial calculator in the below ways to get to that. Current yield and yield to maturity, the only difference between the two is your current yield is what you're getting per year now. Yield to maturity is if you held that bond through the life of a loan until it expires. Talk a little bit about preferred stocks with you guys in case you don't know. I usually give 3 lessons in one, and so one day when I teach this in seat, and so that's kind of the idea there. Preferred stocks act like bonds in a lot of ways, even though you buy and sell them like a stock would, right? So, and their preferred shares are issued by corporations in many of the same ways as stock does. All right, and so it's a little easier for those of you who are used to the market to kind of value a preferred stock, buy into them, sell them. You don't need a different account other than your brokerage account to do that. But they pay fixed dividends, all right, that are priority in the dividend world. And they actually don't need to be retired. So preferred stocks can live in ad infinitum forever if need be. So preferred stocks do have risk because they do move in value a little bit more than bonds do. They're just not quite as volatile as stocks. So somewhere in that range of between stocks and bonds, they would fit. I would say they have characteristics of a stock, but they probably act more like a bond in terms of just the investment world. And so the last one that we're going to go over are convertibles. Okay, and convertible securities, all right, here's your 3 lessons in one day. So 1 was bonds, 2 preferreds, 3 convertibles. Yeah, I coach baseball too, remember that, guys. So that's where I show you that stuff. Bonds that may be converted into a stock at the option of a bondholder are basically what convertibles are. And so they're, you know, a synthetic investment option for people. I guess they do have their place. I've never personally experienced, you know, a situation where someone would really need to have a convertible, but it works like this. So a convertible, a company says, hey, listen, I want to give out kind of a bond. All right, I want to issue out a bond, but I don't have any really ability to, I don't want to have to pay that back in higher interest rates, but I'd rather pay it back through stock. All right, and so the long-term effect is that it does dilute the stocks out there by making more stocks out there, but it's not like it happens all at once. It happens slowly because those investors who buy these products, you know, choose to enact when that happens. And so because of that, there isn't really much of a consequence for the company. They still do have to pay an interest rate, even though it's smaller than normal. And they're always callable by the corporation as well if they want to roll the bond to a stock at any time. And you can also, as a bondholder, callable. So you can roll it from your bond to a stock or convertible to stock at any time, offering the safety of bonds and potential for growth if converted into a stock. These seem great for corporations, and I'm sure that they might have a place in some investors' world, but I've never really experienced too much of those, and they don't really get too much attention in the world of investments. And so last thing we're going to talk on in just an investment type are mutual funds and ETFs and what those are. And so mutual funds are actively professionally managed portfolios that people invest into. There's two types: closed-end investments, which means that no one can buy into it anymore. You have to go out on the market and buy shares of the mutual fund, and open-end investments where people are allowed continually to buy into. Mutual funds operate kind of like a stock, but instead of looking at a stock value or something like that, it would be called that's called their net asset value, which is ultimately how much in assets, all the investments that they have in that mutual fund, divided by how many shares there are out there in the mutual fund. Advantages are pretty simple. You would imagine if someone who's smarter than you, who's getting paid a lot more than you are, no offense, me getting paid more than me too, but people who are the best in the game could manage a portfolio. They could do better than you could or me could. At least that's the idea of it. Mutual funds were extremely popular starting in the 80s, the 90s, up through 2000 and 2010. I would say even 5 years ago, very, very popular, but they're starting to fall off. And maybe it's because of the trends that we see moving in our world, but I think one big one is that mutual funds are having a challenge keeping up with historic returns. Okay, they're costly, meaning someone's making millions of dollars to manage that. Actually, many people are making many millions of dollars to manage that fund. You have these different fee types. You've got load, no load expenses, all these things that you have to pay yearly upfront, and it can become cumbersome to the final return that you get on your investment. Furthermore, very few mutual funds, after fees are included, actually outperform the stock market average. And so the question is, why not just invest in the stock market average itself, which is a great option. And usually, my personal advice is like, hey, listen, up until you have $10,000 invested in the market, which will take quite a few of us a long while, just simply invest in the index that tries to track the larger market. Okay, and so the S&P 500 is very common index, the most popular one in the world. All right, the SPY, buy into it so you can just mimic the market, and that is perfectly good. That's okay. Most of these are low cost. Matter of fact, the newest trend is no cost index funds, and they're great. They're good. They're simple, but that doesn't mean that they're bad. As a matter of fact, most of us, our goal should just be to get market exposure. And so one other aspect of that you can do is called an exchange traded fund, which is very similar to an index fund, only it tracks a sector of the market. Again, we're getting a little bit more into the intimates of the market, right? And it's going to cost us maybe a little bit more in expenses. But exchange traded funds do have their place, and they are growing in popularity. Every day, people are taking money out of mutual funds, out of the bond market, putting them in ETFs, putting them in index funds, and the goal being, hey, I want to really mimic the market, and that is period my goal. And that's a good, I think that's a good goal to have. You get 10% interest. You see what the time value of money does for you. I would say the market moves differently now because of all of these different investment types. People buy and sell broad sectors of the index of the market instead of individual securities because of that. And it's definitely changing. It's not necessarily a bad thing, but it is definitely a way our world is moving toward. And my advice to others is always like, yeah, until you really get quite a bit of money moved into the market, instead of buying one individual stock, which comes with it associated risks that are very undiversified. You have a potential for some unsystemic risk, as we talked about. Instead, just buy into the whole market. All right, guys. Well, that concludes Module 5. Appreciate y'all.